In Rich Dad, Poor Dad, Robert Kiyosaki sets the stage for the contrasting philosophies of his two dads, his biological father, referred to as Poor Dad, and his best friend's father, Rich Dad. Both men shaped his understanding of money and investing, but in vastly different ways. Poor Dad, a highly educated man, believed in the traditional path of getting a good education, securing a stable job, and saving incrementally. Rich Dad, on the other hand, had little formal education, but possessed financial acumen. He advised Kiyosaki to acquire assets that generate income, rather than relying solely on a job. The introduction serves as a preview of the divergent financial teachings that Kiyosaki will explore throughout the book, emphasizing the importance of financial education and the limitations of the conventional wisdom imparted by schools and society. In Chapter 1 of Rich Dad, Poor Dad, Robert Kiyosaki introduces us to the foundational differences between his two dads' views on money. The chapter is essentially a tale of contrasting philosophies, financial strategies, and life lessons that Kiyosaki learned from both men. His poor dad, who is actually his biological father, is a highly educated man holding a PhD. He is well respected in his field and holds a secure job with good benefits. Poor Dad's advice reflects conventional wisdom. Get a good education, find a secure job, and save money. He values hard work and believes that working for someone else is the most secure path to financial stability. According to Poor Dad, assets are things to be acquired after achieving a certain level of financial security through hard work and savings. The idea of taking financial risks or investing in anything other than a secure retirement plan is foreign and somewhat dangerous to him. On the other hand, Kiyosaki's Rich Dad is the father of his best friend, Mike. Rich Dad didn't finish high school and instead focused on understanding how money works in practice, not just in theory. Unlike Poor Dad, Rich Dad is a risk-taker but in a calculated way. He invests in assets that generate income, such as real estate or businesses, rather than merely saving or investing in traditionally safe financial instruments like bonds or fixed deposits. Rich Dad believes that financial literacy is the key to wealth and that one must understand and master the basics of money, such as the difference between assets and liabilities, to achieve financial independence. One of the pivotal moments in the chapter comes when young Kiyosaki and his friend Mike seek advice from Rich Dad on how to make money. Instead of giving them money or answers, Rich Dad gives them an opportunity. He offers them jobs at one of his stores. Their wages are minimal, but the real lesson is not about earning, but about the value of money and work. Frustrated with their low wages, the boys are initially unable to see the value in the experience. But Rich Dad explains that the situation is a lesson in what the majority of people do: work hard all their lives for little money, paying more in taxes as they earn more, and becoming trapped in a cycle of work and bills. Rich Dad also introduces the boys to the concept of rat race, where people are stuck in a never-ending cycle of earning and spending without gaining financial freedom. He emphasizes that by simply saving money and avoiding financial risks, one can never become rich. Rich Dad believes that your profession is what puts food on the table, but your business is what makes you rich. In other words, one must focus on acquiring assets, things that put money in your pocket, rather than just working for a paycheck. Kiyosaki learns that being financially literate is more than just making money. It's about understanding money. Rich Dad explains that the rich don't work for money. They make their money work for them. This principle is central to Rich Dad's philosophy. He teaches that acquiring assets, even when you have little money, is key. Even if you have a small sum, investing it wisely in things that will generate income is far better than keeping it in a savings account. He also touches on the importance of taking calculated risks, stating that failure is part of the process, a stepping stone rather than a stumbling block. Chapter 2 of Rich Dad, Poor Dad by Robert Kiyosaki delves deeper into the subject of financial literacy by focusing on the role of assets and liabilities in an individual's financial health. Titled, "The Rich Don't Work for Money," this chapter aims to shed light on a critical financial concept that sets apart the rich from the poor and middle class: the accumulation of income-generating assets. The chapter starts by highlighting one of Rich Dad's defining statements: the poor and the middle class work for money. The rich have money work for them. To most people, the idea of having money work for you seems abstract or unachievable, especially if you've been conditioned by traditional beliefs about work and money, often represented by Poor Dad's views. Rich Dad points out that the conventional path people follow involves trading time for money, which is a never-ending cycle that keeps individuals entrapped in financial mediocrity. This rat race, as he calls it, ensures that most people continue working hard, stuck in jobs they may not like, mainly to pay off their debts or liabilities and meet their daily expenses. According to Rich Dad, the most glaring mistake people make is confusing assets with liabilities. Most people consider their home an asset, but in Rich Dad's view, an asset is something that puts money in your pocket, and a liability is something that takes money out of your pocket. For many people, a home is a liability because it incurs costs like mortgage payments, maintenance, taxes, and insurance without generating any income. On the other hand, assets, according to Rich Dad's definition, could include investments like real estate properties that are rented out for income, stocks that pay dividends, or businesses that generate profits. Rich Dad's golden rule is to buy assets, not liabilities. He suggests that instead of saving every penny and avoiding debt like the plague, one should focus on accumulating assets that generate ongoing income. This income, in turn, can be reinvested to acquire more assets. This is the fundamental principle behind the concept of making money work for you. The chapter emphasizes that the rich focus on their asset columns while everyone else focuses on their income statements. It's not about how much money you make. It's about how much money you keep and how hard that money works for you. Rich Dad advises that every time you receive your paycheck, you should set aside a certain portion for investing in income-generating assets before spending money on anything else. By doing so, you're prioritizing the growth of your asset column over immediate pleasures or non-essential expenses. Rich Dad also discusses the fear and greed that drive people's financial decisions. Fear of losing money keeps them away from investing, and the desire for immediate gratification compels them to spend money on liabilities rather than invest in assets. He advises overcoming these emotional barriers by educating oneself about money and investments, thereby making informed decisions rather than impulsive ones. This education does not necessarily mean formal schooling, but acquiring real-world knowledge, skills, and experience. Another important lesson in this chapter is the concept of risk. According to Rich Dad, there's a substantial difference between being risky and taking calculated risks. Without financial literacy, every investment appears risky, and the potential for making errors is high. However, with the right knowledge and understanding, one can mitigate risks and make wise investments that yield high returns. Rich Dad states that it's not the investment that is risky, it's the investor. He encourages the reader to become financially educated, to distinguish good investment opportunities from bad ones, and to understand the tax advantages and protections that are available to those who invest wisely. For example, the rich are often able to minimize their tax burden by earning income through capital gains and dividends, which are often taxed at a lower rate than wages or salary. Chapter 3 of Rich Dad, Poor Dad by Robert Kiyosaki continues to build on the principles discussed in earlier chapters, focusing particularly on the concept of minding your own business. Titled, Why Teach Financial Literacy? This chapter emphasizes the value of understanding the fundamental principles of money as a form of literacy, just as essential as reading and writing. Kiyosaki starts by discussing the limitations of the educational system, particularly its focus on preparing students for jobs by teaching them technical skills, but not the financial literacy necessary to manage the money they will earn. According to Rich Dad, the lack of financial education in schools is why many people, including highly educated individuals, often struggle financially despite having decent salaries. It is in this context that Rich Dad introduces one of the chapter's most important lessons. You must know the difference between an asset and a liability and buy assets. Rich Dad explains that the rich focus on accumulating assets, such as real estate, stocks, bonds, and intellectual properties, which generate money passively. The middle class and poor, on the other hand, accumulate liabilities that they think are assets, like houses, cars, and other items that drain money out of their pockets. For Rich Dad, an asset is something that puts money in your pocket without you having to work for it. A liability takes money out. Understanding this distinction and applying it is the cornerstone of financial literacy. The chapter also introduces the concept of minding your own business. Kiyosaki explains that most people work for everyone else but themselves. They work for the company that employs them, then for the government through taxes, and finally for the bank that holds their mortgage. Despite this, they neglect their own financial well-being by failing to acquire assets. The issue, according to Rich Dad, isn't just that people are financially illiterate. It's that they're actively trained to avoid understanding their own finances. They're trained to be good employees, to work for money, but not to understand how money works. So they end up in a never-ending cycle of earning and spending. Rich Dad's view on personal financial management is straightforward but unconventional. Rather than focusing on a high-paying job, he recommends concentrating on building and buying income-generating assets. His philosophy is not to simply save money, but to increase one's assets so they can provide a steady income. These assets can include anything from real estate and stocks to royalties from patents and licensing agreements. Kiyosaki delves into the technicalities of balance sheets and financial statements to illustrate his point. He shows examples of what the financial statements of a rich person and a middle-class person might look like, highlighting how the rich person's balance sheet is asset-heavy while the middle-class individual's sheet is cluttered with liabilities. One of the most impactful sections of this chapter is where Rich Dad elucidates that working hard for money is an old formula born in the day and age of manual labor, and it doesn't hold up in today's information age. Money is one form of power, but what is more powerful is financial education. According to Rich Dad, the money will go to those who are financially literate, can manage it well, and are attuned to the subtleties and nuances of managing one's own business and financial future. This chapter serves as a wake-up call to the reader to become financially self-aware. It's not enough to just have a job and earn money. One must also understand how to make that money work for them through the acquisition of assets. Moreover, Kiyosaki suggests that we need to prioritize financial education, both for ourselves and the next generation. The chapter argues that financial education isn't a luxury. It's a necessity for those who want to enjoy financial freedom and security. Chapter 4 of Rich Dad, Poor Dad by Robert Kiyosaki addresses the topic of taxes and corporations, providing further insight into the financial philosophy of Kiyosaki's Rich Dad. Titled The History of Taxes and the Power of Corporations, the chapter delves into how the rich make strategic use of taxation laws and corporate structures to their advantage, in contrast to the middle class and the poor, who often bear the heavier tax burden. The chapter begins by providing historical context about taxation, explaining that taxes were virtually non-existent before the two world wars. Initially, income tax was introduced as a measure to fund wartime expenses, with the assurance that it would only affect the rich. However, what started as a temporary measure has now become a permanent fixture and affects people across all income levels. Rich Dad argues that knowing the history of taxes helps in understanding how the rich play the game differently. Kiyosaki uses the chapter to elucidate a primary difference between his Poor Dad and Rich Dad. Poor Dad, like most people, held the belief that the route to success and financial stability lies in getting a good job. This traditional line of thought, however, often leads to higher taxation. The harder you work, the more you earn, and the more you earn, the more you pay in taxes. This creates a sort of punishment for hard work within the system, as increasing your income moves you into higher tax brackets. In contrast, Rich Dad argues for a different approach. He explains how the rich often use corporations as a vehicle for protection against taxes. While employees earn and get taxed, the rich earn money through their corporations, which get taxed at a lower rate. More importantly, corporations can claim a wide variety of expenses, deductions, and credits that individuals cannot, thereby reducing their taxable income significantly. By the time the money reaches the individual who controls the corporation, much of it has been shielded from high tax rates. Kiyosaki also discusses the benefits of financial intelligence. It's not just about making money, but also efficiently managing and protecting it. One of the ways to do this is through the strategic use of debt and expenses to generate new income while simultaneously offering tax benefits. This concept is very different from the traditional advice of cutting down debt and expenses to save money, which is what Poor Dad advocates. Rich Dad's philosophy doesn't just stop at explaining the how, it also covers the why. According to him, the power of corporations extends beyond financial benefits. It offers you control over your financial future and protects your assets. Being financially literate enables you to understand and navigate the complex world of taxes and regulations to your benefit, just like the rich do. One crucial point that Kiyosaki makes is that financial literacy is not an optional skill, but a necessary one for financial independence. He contends that you don't have to be a certified accountant or a tax expert to understand these financial intricacies. Basic financial education and a willingness to learn can go a long way in empowering individuals to make informed decisions. The chapter also touches on the element of risk. Rich Dad is not advocating for illegal tax evasion, but for understanding the legal ways to protect one's assets. Many people avoid getting into investing or owning corporations because they perceive it as too risky. However, Rich Dad argues that what is risky is not having financial education and sticking to outdated financial practices. Chapter 5 of Rich Dad, Poor Dad by Robert Kiyosaki is titled The Rich Invent Money, and it takes the reader deeper into the mindset and activities that set apart those who attain financial freedom from those who don't. While the earlier chapters focus on the difference between assets and liabilities and the importance of financial education, this chapter zeroes in on the creative aspect of wealth generation. One of the main tenets of this chapter is the idea that financial aptitude is what sets the rich apart from the rest. While many people look for opportunities to make quick money, the rich focus on acquiring valuable skills and knowledge that can help them recognize and create financial opportunities. In other words, rather than simply playing it safe by sticking to a 9-to-5 job and traditional investment vehicles, they take calculated risks to invent new ways of making money. Rich Dad emphasizes the importance of financial education and intelligence in this process. According to him, many people think they need money to make money, but what they actually need is financial intelligence. This intelligence, he argues, doesn't come from simply saving money, avoiding debt, and investing in a diversified portfolio of stocks, bonds, and mutual funds, as is often traditionally advised. It comes from being financially literate, understanding market trends, recognizing opportunities, and being creative in inventing ways to capitalize on these opportunities. Kiyosaki narrates his own experience with real estate investing as an example. While most people saw a declining market as a risky environment, he saw it as an opportunity to buy valuable assets at a lower price. He explains that he and his wife took financial seminars and courses to better understand how to take advantage of the real estate market. Armed with knowledge and guided by mentors, they ventured into the market and eventually succeeded. This chapter challenges the conventional wisdom around money, emphasizing that courage, insight, and knowledge are more important than money itself when it comes to building wealth. Rich Dad highlights the fact that there are no bad investments, there are only bad investors. A financially intelligent person can make a seemingly risky investment profitable, while a financially illiterate person can turn even a safe investment into a bad deal. The idea of inventing money doesn't necessarily refer to creating new currency, but to creating opportunities that others can't see or understand. This often involves breaking free from the mindset that one must work hard for money and transitioning to a perspective where one works to learn. Rich Dad points out that this is where the power of financial education becomes evident. The more one learns about different asset classes, markets, and financial instruments, the more adept one becomes at inventing ways to make money work for them. Kiyosaki also addresses the fear that often holds people back from taking risks and investing. He acknowledges that fear is a natural human emotion, but notes that it's how one deals with fear that makes the difference. People often use fear as an excuse not to invest, letting it paralyze them into inaction. Rich Dad advises turning fear into motivation to learn and grow. Instead of avoiding a seemingly complex or risky financial opportunity, one should delve deeper, seek advice, and educate themselves to mitigate the risks and make informed decisions. Rich Dad's philosophy can be summed up in the maxim, "Don't work for money, make money work for you." But this chapter adds another layer to that wisdom. It encourages not just smart investing in assets, but also investing in one's financial education to create or recognize more opportunities for wealth generation. It's about actively seeking to invent money by pushing boundaries and expanding one's understanding of what's possible in the financial realm. Chapter 6 of Rich Dad, Poor Dad by Robert Kiyosaki is entitled Work to Learn, Don't Work for Money. In this chapter, Kiyosaki delves into the intricacies of the modern job market and employment, contrasting them with the entrepreneurial mindset advocated by his Rich Dad. Unlike earlier chapters, which focused heavily on financial literacy and investment strategies, this chapter pivots towards the value of acquiring diverse skill sets and knowledge over the pursuit of a high-paying job. Kiyosaki starts by emphasizing that traditional education often prepares individuals to become good employees by instilling a fear of making mistakes and failing, rather than teaching them the skills needed to innovate and think creatively. His rich dad suggests that instead of seeking job security and a stable paycheck, people should aim to acquire a wide range of skills and experiences. It's not just about mastering the subject you majored in at college. It's about being versatile, flexible, and skilled in various domains, including sales, marketing, investment, and management. Rich Dad's philosophy challenges the conventional wisdom about career advancement. Most people tend to specialize in a narrow field, climbing up the corporate ladder by enhancing specialized skills. While specialization may lead to job security and even high income, it often comes at the expense of financial independence and adaptability. Rich Dad argues that what really matters in the long run is your ability to adapt to new situations, take on various roles, and make informed decisions that will benefit your financial future. In this chapter, Kiyosaki recounts his own experiences working various jobs, not to earn money, but to learn diverse skills. He discusses his stints in sales, marketing, and management, where he acquired the skills that would later serve him in his entrepreneurial ventures. The point is made clear. He wasn't working those jobs for the money. He was working to learn. This shift in perspective, according to Rich Dad, is what separates the financially free from those who are bound to a lifetime of working for money. Those who are financially educated aim for learning experiences that broaden their skill set and increase their financial intelligence. Whether it's negotiating deals, analyzing investment opportunities, or understanding tax laws, these skills make them more adaptable and prepared for the varied challenges of the financial world. Rich Dad emphasizes the need to be not just literate in one's specialized field, but also financially literate. He states that having more than one skill can actually multiply your value. For instance, combining sales skills with financial understanding creates a potent mix that can be exceptionally valuable. Moreover, being open to learning across different fields can present opportunities that one might not have recognized otherwise. Kiyosaki also touches on the fear factor again, stating that fear of venturing into the unknown often holds people back from diversifying their skills. This is where financial education comes into play. The more educated you are about financial matters and the diverse skills associated with it, the less frightening it becomes to step out of your comfort zone. The chapter encourages the reader to view life as a broad educational experience, where the goal is to learn, not to earn. It's a call to challenge societal norms and traditional educational paradigms that promote job security as the ultimate goal. Instead, Kiyosaki advocates for an approach that values financial education, adaptability, and a willingness to make mistakes and learn from them as the pathways to true financial freedom. Chapter 7 of Rich Dad, Poor Dad, titled Overcoming Obstacles, focuses on identifying and overcoming the barriers that hinder financial freedom. According to Robert Kiyosaki, the main obstacles people face are fear, cynicism, laziness, bad habits, and arrogance. Each of these barriers has a substantial impact on financial behavior, affecting how individuals earn, save, spend, and invest their money. Kiyosaki contrasts the attitudes of his two dads toward these obstacles and elaborates on the mindset and strategies that can help overcome them. The chapter starts with the obstacle of fear, particularly the fear of losing money. Many people, including his poor dad, avoid taking financial risks due to this fear, which limits their potential for wealth creation. Rich Dad's approach is different. He believes that the fear of losing money is natural, but not an excuse to avoid financial risks. Instead, one should educate oneself about financial matters to make informed decisions. Knowledge is the best tool for overcoming fear. Cynicism is the next obstacle. Kiyosaki describes how a doubting attitude, often shaped by past failures or societal conditioning, can prevent people from seizing opportunities or even recognizing them. While skepticism can serve as a protective measure against scams or bad investments, excessive cynicism can be paralyzing. Rich Dad's solution is to question cynicism and try to understand its root cause, usually a lack of knowledge. Once the lack of knowledge is identified, it can be addressed through education and mentorship. Laziness is another significant barrier to financial independence. Contrary to popular belief, Kiyosaki says that laziness is not always manifested through inaction. Sometimes, people use busyness to escape the things they should be focusing on, such as financial education. Rich Dad's remedy for laziness is simple: desire. Having a strong desire, or a why, can be incredibly motivating and can help overcome laziness. He often says, the bigger your why, the easier the how. Bad habits, particularly those related to money, can be detrimental to financial growth. Poor Dad had the habit of saying, "I can't afford it," effectively closing off any discussion or thought about how he could afford something. Rich Dad, on the other hand, would say, "How can I afford it?" This question opens up possibilities, encouraging problem-solving and creative thinking. The idea is to convert disempowering thoughts into empowering actions. The final obstacle addressed is arrogance, which Kiyosaki defines as ego plus ignorance. People who think they already know everything are unlikely to seek further knowledge, making them susceptible to financial mistakes. Arrogance often manifests in the form of dismissing anything that challenges one's beliefs or opinions. Rich Dad's advice for overcoming arrogance is to admit what you don't know and then seek to learn it. He believes that what you know makes you money, but acknowledging what you don't know can save you money. Kiyosaki emphasizes the importance of financial education as the ultimate tool for overcoming these obstacles. Being financially educated equips people with the knowledge and skills needed to navigate the complexities of the financial world, thereby reducing fear and cynicism. It also fosters a proactive attitude towards wealth creation, helping to overcome laziness, bad habits, and arrogance. The chapter encourages readers to introspect and identify their own obstacles to financial freedom. It advocates for a mindset shift, from avoiding problems due to fear or ignorance to actively seeking solutions through education and action. The idea is not just to work for money, but to let money work for you, and to not let psychological barriers deter you from achieving financial independence. Chapter 8 of Rich Dad, Poor Dad by Robert Kiyosaki is entitled Getting Started. In this chapter, Kiyosaki provides actionable steps for individuals who are keen to set off on their journey toward financial freedom. Unlike the previous chapters, which lay the groundwork of financial literacy and mindset, this chapter offers a more practical guide filled with tips, strategies, and advice for taking that crucial first step. Rich Dad's philosophy of financial freedom rests on the acquisition of assets that generate income rather than expenses or liabilities. The fundamental principle is to have your money work for you rather than you working for money. With that in mind, this chapter is all about enabling you to start building your own portfolio of income-generating assets. Kiyosaki begins by emphasizing that the single most potent force one can employ to start the journey towards financial independence is the power of the human mind. He insists that it's not money, but rather ideas that make a person rich. A person's creativity and financial intelligence are their most significant assets. Being financially educated enables one to come up with innovative solutions to problems, and that is often the starting point of a valuable enterprise or investment. One practical recommendation in this chapter is to start small. Kiyosaki recounts his experiences of investing in small real estate deals that did not require much capital but offered valuable learning experiences. The key takeaway is to learn by doing. Start with small, manageable risks to understand the nuances of an investment opportunity. The objective is not just to earn money, but also to learn. Mistakes are part of the process, and each mistake is a lesson that brings you one step closer to financial freedom. Another point Kiyosaki makes is about taking baby steps. He suggests starting with individual skills you can acquire or small investments you can make. It could be something as simple as attending seminars, reading financial books, or even playing financial education games. Kiyosaki himself developed a board game called Cash Flow, aimed at teaching individuals about investing and accounting in a fun and interactive manner. He believes in gaining both theoretical knowledge and practical experience, asserting that the combination of the two is critical for success. Kiyosaki strongly advocates for seeking like-minded individuals or mentors who can guide you through your financial journey. According to him, who you spend your time with can influence your financial future. Surrounding yourself with financially intelligent people not only helps you learn from them, but also challenges you to think critically and be more accountable. The chapter also talks about reducing expenses and simplifying one's lifestyle as a pathway to having more money to invest. Rich Dad emphasizes the value of self-discipline in managing one's finances. While it may be tempting to upgrade your lifestyle as soon as you start making more money, the discipline to delay gratification and invest that money instead can be a game changer. An essential theme in this chapter is to take action. Kiyosaki criticizes armchair investors who read all the books and attend all the seminars but never actually invest. Inaction is often rooted in fear of failure. However, as earlier chapters have discussed, overcoming fear is a crucial aspect of becoming financially educated and independent. Finally, Kiyosaki shares the 10 steps Rich Dad recommended for financial success, which range from a commitment to financial education, setting clear goals, and continuously honing your investment skills. These steps serve as a comprehensive guide that encapsulates all the principles and practices discussed throughout the book. Chapter 9 of Rich Dad, Poor Dad, titled Still Want More? Here are some to-dos, serves as a practical finale to the foundational concepts laid out in the preceding chapters. This chapter aims to push readers from contemplation to action by offering a list of concrete steps to take on their journey toward financial independence. Rather than just discussing theories or mindsets, Robert Kiyosaki provides a roadmap for implementing the lessons learned from his two dads. One of the first things Kiyosaki emphasizes is the need for financial education. This is not a one-time event, but a lifelong process. Financial education is not merely about learning the language of money, but also about understanding how money works and how to make it work for you. In line with this, he encourages readers to take classes, read books, and attend seminars that will further this knowledge. He also notes that education should extend to understanding markets, law, and taxes, fields that have substantial impacts on one's financial health. Next, Kiyosaki encourages readers to make a choice between security and freedom. The traditional route, what his poor dad advocated for, is to seek a good job with a stable income. However, as Rich Dad pointed out, this often leads to a cycle where individuals work hard but also accumulate debt, only to find themselves in need of higher income, and the cycle repeats. The alternative is to seek freedom by becoming financially educated and making informed investments in assets rather than liabilities. This choice is a commitment and will require continuous learning and courage to face risks and failures. Setting goals and creating a game plan are also stressed as crucial steps. According to Kiyosaki, the very act of writing down one's financial objectives makes them more tangible and achievable. It forces you to clarify what you want to achieve, how you plan to do it, and what you are willing to sacrifice to get there. He notes that people who write down their goals have a substantially higher chance of achieving them. One of the more pragmatic steps outlined is to get your finances in order. Kiyosaki suggests taking stock of your financial situation by listing your assets and liabilities and understanding your cash flow. Once you know where you stand, it becomes easier to plan where you want to go. This financial snapshot serves as both a reality check and a baseline for measuring progress. Following this, Kiyosaki introduces the idea of seeking mentors, but cautions against cynics and doomsayers. Surrounding oneself with individuals who are financially educated and optimistic can have a transformative effect on one's own outlook and actions. However, he also stresses the importance of being critical and not taking any advice at face value, even from mentors. Everyone's financial situation and risk tolerance are different, so it's crucial to adapt advice to one's own circumstances. One of the most critical steps in this chapter involves taking action. Kiyosaki emphasizes that knowledge without action is futile. He encourages starting small, a small investment, a small business, or any other small venture that is manageable but offers room for learning and growth. The focus should be on learning more than earning. Even if the venture fails, the learning will make the next venture more likely to succeed. Finally, Kiyosaki revisits the concept of not working for money. The goal, as reiterated throughout the book, is to have money work for you. This chapter ends by urging readers to take the first step, however small, toward achieving this goal. Whether it's acquiring financial education, making a small investment, or seeking mentors, taking action is what will set you apart from those who remain trapped in the rat race. Chapter 10 of Rich Dad, Poor Dad serves as a conclusion, wrapping up the lessons learned from Robert Kiyosaki's two dads while propelling readers toward future learning and action. The chapter is titled Final Thoughts, and it aims to summarize the key teachings of the book while re-emphasizing the importance of financial education. At the core of the chapter is a recapitulation of the book's central thesis, the need for a comprehensive financial education that goes beyond traditional schooling. According to Kiyosaki, the educational system is geared toward producing employees who work for money, but it lacks in teaching people about money itself. He asserts that financial education is largely neglected in schools, leading to widespread financial illiteracy. The chapter further drives home the point that financial freedom is not just about accumulating wealth, but about understanding and managing money in a way that makes it work for you. One of the crucial aspects Kiyosaki discusses is the importance of understanding and managing assets. While his poor dad prioritized salary and job security, his rich dad emphasized the importance of investments and assets. The ability to generate income from assets rather than from employment is what sets financially free individuals apart from those who are trapped in the rat race. Kiyosaki reminds readers that the world has changed significantly in terms of economics, and what worked for the previous generation, in terms of job security and pension plans, may not work for the current or future generations. He underscores the volatility of traditional security nets like Social Security and pension plans, arguing that the only way to ensure financial security is to take control of one's own financial education and investments. An essential part of this chapter is Kiyosaki's urging for readers to take action. Echoing sentiments from earlier chapters, he stresses that reading the book should not be an end, but a beginning. It's a call to action for readers to take control of their financial futures by investing in their financial education. Whether it's through taking courses, reading more books, or seeking out mentors, he emphasizes the importance of continuous learning and practical application. Additionally, Kiyosaki offers some specific advice for anyone ready to begin their financial education journey. He advises starting small, taking calculated risks, and learning from failures. Kiyosaki shares that his investments weren't always successful, but each failure brought valuable lessons that equipped him with the knowledge and experience to make better decisions in the future. He also talks about the importance of giving back. According to Kiyosaki, true wealth is not just about amassing money, but also about being able to make a positive impact on others and the community at large. He suggests that the ultimate aim of becoming financially literate should be to improve one's own life and the lives of those around them.